$4.27 per ounce right now. That's not a number. That's a warning shot. And if you think this is just another bull market, you're about to miss the biggest wealth transfer in modern history. Here's what nobody's saying out loud. Central banks are reportedly panic buying gold at unprecedented rates. We're talking around 1,000 tons annually for 3 consecutive years. In recent interviews, Jamie Dimon at JP Morgan suggested gold could potentially reach $10,000. Ray Dalio has compared owning gold to understanding history. Ken Griffin has openly discussed how investors are increasingly trusting gold over traditional currencies. Think about that for a moment. More than fiat currency. Check. Now here's where it gets dangerous. Because what happened around December 1st? Most people completely missed it. The Federal Reserve ended quantitative tightening. They stopped draining money from the system. And on December 10th, they're reportedly cutting rates again. That's not just policy adjustment. That signals a major shift because while they were fighting inflation, the labor market took a serious hit. Approximately 32,000 private sector jobs disappeared in 1 month. The steepest drop we've seen in 2.5 years. Small businesses are closing. Wages are frozen. Consumer spending is collapsing. And the Fed, they see it. John Williams, New York Fed president, recently stated they have room to lower rates. My translation, there's serious concern. Verified. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Now, let's talk about what gold is actually screaming at us, because this isn't just a price move. This is what I call a trust collapse. Watch this. The dollar index recently fell below 100. That's a psychological cliff. Back in 1999, the dollar made up approximately 71% of global reserves. Today, around 58.4%. The dollar is bleeding market share. And where's that money flowing? Gold. Physical gold. Kazakhstan has been buying record amounts. According to reports, Brazil made their first purchase in 4 years. Poland is reportedly targeting 30% gold reserves. 30%. These aren't just investments in my view. These are strategic hedges. And here's what should really make you think. According to financial analysts, for the first time since 1996, central banks now reportedly hold more value in gold than in U.S. Treasury bonds. More gold than U.S. debt. That's not just a shift, in my opinion. That's a revolution happening quietly. Undeniable. But wait, because this exact pattern has played out before, 3 times in modern history. And every single time, the people who didn't see it coming paid the price. 1933. America is drowning. Banks collapsing. Roughly 25% unemployment. Franklin Roosevelt does the unthinkable. Executive Order 6102. He mandates gold confiscation. Citizens had to turn it in at approximately $20 per ounce or face serious consequences. Then once the government controlled it all, he revalued it to around $35, roughly a 40% devaluation. Overnight, citizens lost purchasing power. The government gained control. Gold became the tool of the reset. And the people paid the price. Check. August 15, 1971. Vietnam is bleeding America's resources. France famously sends a warship to collect their gold. A warship. The system is cracking. So Nixon goes on national television and ends the gold standard. One speech. Bretton Woods dies. And what happens next? Gold surges from approximately $35 to over $800 by 1980. Inflation tears through the economy. Oil shocks, stagflation, dollar collapses. But gold becomes the asset people trust. Those who saw it coming were protected. Those who didn't were wiped out, verified. 2008, Lehman Brothers evaporates. Bear Stearns gone. AIG gets bailed out with taxpayer money. And the Fed prints trillions of dollars, not metaphorically, literally. Gold climbs from around 700 to 1900. Why? Because people understood something fundamental. When governments print, gold tends to protect. When trust erodus, gold tends to survive. When the system resets, gold has historically been the bridge. December 5, 2025, same pattern, different decade. U.S. debt recently passed $36 trillion. Approximately 20 trillion of that matures within 10 years, which means two choices: pay it off or roll it over. They can't realistically pay it off, so they'll likely roll it over. But here's the trap. Interest rates went from near zero to around 5%. In roughly 18 months, the cost of servicing that debt is consuming the budget. It's becoming a mathematical prison in my view, and the Fed knows it. That's my interpretation of why they're cutting rates. Not because the economy is thriving, because the debt structure is becoming unsustainable. If they don't cut, the system faces serious pressure. But if they do cut, inflation could roar back. They're in a difficult position. And gold reflects it. Gold always reflects it. Undeniable. Now, here's where it gets really dangerous from my perspective. Because this isn't just about the dollar anymore. The IMF's chief economist recently made a striking statement that the global economic system that has operated for the last 80 years is being fundamentally restructured. Restructured, not adjusted, not modified, restructured. The old rules are breaking. The new rules haven't been fully written. And in that gaping tigers, uncertainty lives. Countries are preparing. China reportedly hasn't disclosed real gold reserves in years. Russia has reportedly dumped treasuries and increased gold holdings. Saudi Arabia has been signing oil deals in yuan. The petrodollar system that's existed since 1974 showing cracks. And when that system breaks, in my analysis, gold becomes the universal language again, because institutional trust is eroding. But gold has 5,000 years of trust. Check. Let's talk technicals for 30 seconds because the chart is telling a story. 2. Gold attempted to break through 4,250 multiple times. Failed. Pulled back to around 4164. Support held. Now it's consolidating, coiling like a spring. If it breaks below approximately 4085, could see further pullback. But if it breaks above 4,250, technical analysts suggest next stop could be 5,000. And after that, minimal resistance, no clear ceiling, just pure momentum potential. Because once the psychology shifts from "is this too high" to "how high can it go?" that's when things can get exponential, undeniable. Now watch this. Most people aren't paying attention to this signal. Silver recently hit $57. Touched approximately 58.98 this week. Up roughly 97.3% this year. Why does that matter? Because silver is gold's little brother in many ways. When gold moves, silver often follows. But when silver starts outpacing gold, that's a signal worth noting. It's telling you two things in my view. 1. Industrial demand is reportedly exploding. 2. People are rotating into hard assets broadly, not just gold, everything tangible, because paper promises are losing perceived value verified. The World Gold Council recently released projections. Pay attention to this. They suggest gold could surge another 15 to 30% in 2026. That would put it between approximately 4,800 and 5,500 conservatively. But they also outlined more extreme scenarios. If geopolitical stress escalates, if yields stay negative, if central banks accelerate buying, some say 6,000. Various analysts suggest 10,000. Others mention 15,000 and a few. And the ones who study historical patterns all are discussing 38,000, even 138,000.
Impossible.
Not if you understand the theoretical gold revaluation framework. Here's how it works. Theoretically, the U.S. government officially values gold at around $4,222 per ounce. That's from 1973. Hasn't been updated. But the market currently says 4,200. Now imagine the government hypothetically decides to reset gold's value to back the 36 trillion debt. 36 trillion divided by approximately 8,000 tons of gold equals roughly 138,000 per ounce theoretically. Now, do they actually have that gold? That's the question some analysts raise, because the last comprehensive audit of Fort Knox was reportedly in 1953, 72 years ago. The full inventory hasn't been publicly verified since. But if a crisis forces a revaluation hypothetically, and if they need gold to restore confidence, the price could theoretically go anywhere. Check. Now, let's talk about what you might be feeling right now because I know what could be in your head. You're thinking, this sounds extreme. Gold at 10,000, that's fear-mongering. But here's what history shows. Every single time gold made a massive move, people said the exact same thing. In 1971, they doubted $100. In 2008, they doubted 1,000. In 2020, they doubted 2,000. And now at 4,200. Some are still doubting. But the people who positioned early, they're not doubting. They're prepared because they understood something fundamental. Gold doesn't move primarily because of speculation. Gold moves because of fear. Fear of inflation, fear of conflict, fear of collapse, fear of the unknown. And right now, all four are arguably in play. Undeniable. So what happens next? Here's one likely sequence in my view. December 10th, Fed potentially cuts rates 25 basis points. Gold could rally, potentially breaks through 42.50. Momentum could accelerate by early 2026. Gold might test 5,000 if it breaks. There's no telling where momentum stops. But here's the nuance. This cut likely isn't the start of a long easing cycle. It appears to be a tactical adjustment. The Fed is trying to thread a needle, support the labor market, without reigniting inflation, but they can't easily do both. Cut too much, inflation returns, potentially cut too little, unemployment could spike. Either scenario, gold could win because in a stagflation environment historically, gold is one of the few assets that can.